Thank you for joining us today. I'm Olivia Rios, Director of Operations and Programs at the Latino Chamber. We know that having capital to operate your business is critical. With so many options, how do you know which form of funding is right for you right now? With an economic climate that is uncertain, we need to be mindful of what will work for your company at the moment. Our expert-led webinar, Unlocking Business Growth, Traditional and Alternative Financial, will be explained. We will provide you with the roadmap to securing the resources you need. Both traditional and alternative options will be shared, as well as how to navigate through this process. Our speakers are Valerie Rivas, Vice President for Community Engagement at Bank of America, and Wilbur Cabrera, Vice President at SoCal Loans. So both will be providing you with a plethora of information on funding. Combined, they have over 30 years of experience in the lending, real estate, and banking arena, and we're fortunate to have them with us today. As far as our programming, we will continue to bring you topics that are relevant and resources that will help you grow your business and thrive. Before we start, we ask you mute yourselves, write questions in the chat box. At the end of the session, we'll have a 10 to 15 minute Q&A where we will address your questions. So at this moment, I'd like to welcome Wilbur and Valerie. So welcome. Thank you for joining us today.
Thank you, Olivia. Thank you so much again, the Los Angeles Latino Chamber of Commerce, for your continued partnership and for allowing us to share access to capital options, but then also alternative ways of financing. My name is Valerie Rivas. I'm Vice President for Business Community Engagement. And just a little bit about myself, I've been with Bank of America for a total of 11 years in the finance industry for 21 years, and I've been serving entrepreneurs like yourself for the last 15 years. So I'm actually very excited to be here and share my expertise with you. And in addition with that, I actually serve on several nonprofit boards throughout Los Angeles County area here in Southern California. And they all serve entrepreneurs, and including the Hispanic Latino Business Council here internally at Bank of America. So we drive different initiatives for the Latino community here in Los Angeles alongside with my colleague. So with that, I wanted to go ahead and get started. So we're going to be covering the 6 C's of credit. And today we have partnered up, Bank of America has partnered up with SoCal Loans because we want to be able to bring you the resources. And you may go to the bank or maybe a lender, and that lender maybe doesn't approve you or you don't meet the qualifications. So we want to create awareness today, this morning, is for you to know where to go when you need funding. Now, I always tell my clients and everybody that I meet, if you have an idea, if you have a new venture, if you are passionate about something that you want to open up, let's talk about it. You have resources like the LA Latino Chamber. You also have SoCal Loans, Bank of America, and other partners that can definitely guide you to get the funding that you need. Now, with that being said, what are we going to be covering today? So we're going to be covering the factors that truly influence. So we're going to take you through a roadmap of what banks and traditional lenders take a look when we're looking at a business application. So what is it that we're looking for, right? So 2 would be capacity and capital, collateral and conditions, character and communication. And at the end, we're going to close out and answer any questions that you may have. Now, before we get into the 6 C's of credit, I wanted to mention that there may be a time in where you may need some sort of funding, whether you're a startup or maybe you are trying to grow a little bit more, where you want to maybe increase your sales. So you maybe need to hire some employees, so that may need for you to get some sort of access to capital. And so we're going to take you through the roadmap of what banks, traditional lenders, take a look at. So when we talk about traditional lenders, we're talking about banks. We're talking about those lenders that take a look at your history. So typically they'll take a look at what you've done in the past. Now, if you're a startup, you're probably thinking, okay, well, that doesn't apply to me, right? Well, that's why we have our partners today at SoCal Loans that will be talking about alternative financing. And this could be maybe that you're in a startup phase, or you're going based on projections, or maybe you need a little bit more than the actual banks or traditional lenders will approve you. Now, what I do want to recommend for you is every time you're looking seeking funding, take a look at your bank first and your lender first, because if you're able to go through the traditional lenders, you're going to get the best available terms and the best available rates that are in the industry. So you don't want to do your disservice to yourself. Keep that communication. We're going to talk about the 6 C's of credit, and communication is actually one of them. We'll get into that shortly. Now, before we get into the 6 C's of credit, I do want to mention something that we do every single year at Bank of America. So we do something called the Business Owner Report. And the reason we do that is we want to get our clients' aspirations, their goals, where they feel the direction of their industry or the company is going. But more than anything, just how we can actually serve them better. So bringing, additional resources or partnerships that can actually scale up their businesses. So I wanted to show you or tell you a little bit about some of the stats that are related into today's workshop. Now, you can find the full report at bankofamerica.com. And also, this report also lets you know that you're not alone and with any type of economic concerns or pretty much the direction of where your company is going. Now, in 2024, 71% of our clients were actually looking for access to capital options. 84% of them were saying that they were currently being affected for their business because of inflation, which is another reason why you should maybe pivot or also take a look at access to capital options. 87% were looking for the revenue to increase, and then 80% were looking to expand their business. So if you think about it, these are all different reasons, and they're pretty high up there, and where you should be prepared to be able to get lending at any given point. Now, here are the 6 C's of credit. Now, the first 5 are crucial to your loan application: capacity, capital, collateral, conditions, character, and communication. I did mention earlier that communication is a key for us to be able to get you to the next level. Now let's dive into it. So for capacity is one of the first things that we take a look at when we take a look at your loan application. Again, when I say we, it's the traditional lenders, how typically we want to see your loan application. So first thing is your capacity to be able to repay the lender. So what that means is we want to be able to see at least $1.25 of excess cash flow for every $1 of debt that you have overall. Another way that you can put this is, let's just say that you have $100,000 and then you have a payment of $1,000, just for the sake of an example. Well, what would happen is we would want to see that you were able to pay us back 1.25 times of that payment, or 25%, right? So that would be capacity, is your ability to pay back the debt. So there's times where I come out with a blank check and I ask people, okay, if you were the lender and I come to you and I say, you know what, I need $1 million and I need this $1 million to get to the next level. Can you please sign it? A lot of people say no because they want to know a little bit more about you. So same when it comes to a loan application, we need to know who you are and pretty much your capacity to be able to repay. Number 2 is capital, or how much money do you have in the bank, is what I like to call it. So we would like to see how much of the revenue you're actually retaining of your business. Now, let's just say a client comes in, rule of thumb as a banker, I would say, let's just say they tell me their revenue is 500,000. Then in that point, I would love to see about $25,000 in their business account. If I don't, then at that point, I want to ask questions like, where is that money at? Maybe they have a different business account. Take a look at their balance sheet. Maybe it's at another bank. But then also, we want to make sure that you're able to have some sort of cushion in case of any type of unexpected expenses should happen. Number 3 is collateral, or I also like to call it, what are you going to use those funds for? So coming into the bank and knowing exactly what you're going to use those funds for not only will help us as lenders being able to structure your loans appropriately. So if you come in and you say, Valerie, I need $1 million, and I'm like, okay, perfect. We're going to get you a 10-year term. Boom, here's your loan. Now, if you come in and you say, Valerie, I need $1 million, 500,000 of that's going to be used for real estate. 200,000 for it's going to be for some vehicles, and then the rest is going to be for working capital. Then at that point, for the piece of real estate, we could actually give you up to 25 years versus, let's just say, 10 years or 20 years. So you could see how that could actually reduce the payment amount, but then also improve your cash flow as well. So very important that you let us know. But then also, the stronger the collateral, the more likely you're able to get a better interest rate versus if you don't necessarily, if it's, let's just say, a working capital loan, or let's just say a small vehicle. So very important that you let your banker know or your accountant know of what you're going to be using those funds for, so we can strategize appropriately for your loans. Number four is conditions. So, what is the current state of the economy and any type of environmental factors? So this could be a couple examples, right? So what did we go through a few years ago, which I hate talking about because it was a devastating time and had to actually distance yourself from a lot of people. But we went through an actual worldwide pandemic. So what happened at that time? There was some businesses that thrived, and there were some businesses that actually, unfortunately, are no longer around because they were not able to pivot appropriately. Yesterday, I was actually at a lunch and learn, and I ended up finding out that some of these businesses were actually using toilet paper. They were selling toilet paper to be able to pivot and kind of just get some sort of revenue to stay afloat. So, what are some current conditions or economic concerns that it may be affecting your industry? Another example I'll give you is back in 2007, I myself opened up an escrow company. My brother had a loan company, and my other brother had a real estate company. So I thought it just made sense to add an escrow company so that way we can all share business. Well, guess what? 2008 market crash. I no longer have that business. That business is non-existent. I did not do my research as far as any type of industry trends or what could happen to be able to be still be able to sustain the business. So I always recommend that if you have not opened up your business or you're looking to open a new venture, that you take a look at the industry and see what are some risk associated with that type of industry so that you don't set yourself up for failure, or at least be prepared and see how you can overcome those challenges. Number five is character. So this could be your credit history as far as your personal side, because most likely if you don't have your business credit, we're probably going to take a look at your personal credit history because most likely that's how you're going to be using your funds. We also want to see how you have relationships with your past interactions with different lenders, any borrower's experience. So, especially if you are some sort of CPA or doctor, will probably want to know when you went to school, what type of experience you have. If you're a manufacturing company, how long have you been doing that? What are some of the how did you get started in that? So that tells your story also. References are always great. Also, so if you have a secretary, you've been in business for 10 years and you have a secretary or a manager that has been there from the beginning, those are things that you will want to let us know so that we can let the underwriter know. And it also shows stabilities. And then, of course, overall reputation. So, just a quick example, there are a couple examples. Actually, we had a doctor, and where he was looking for a significant amount of money. Now, all the C's looked good except for character. Character. So, what ended up happening when we did our due diligence, we ended up finding out that this doctor was actually doing surgery under the influence of alcohol. So, unfortunately, he was not operating anymore and he wasn't generating any future income. So, at that point, it puts the client at risk, but not only the client, but the lender as well to be able to be paid back. So, unfortunately, we had to decline that. Also, another agricultural company, they ended up stealing water. They were making a ton of profits and revenue, but what ended up happening is ended up they ended up stealing water, so they were not paying for water. And so what ended up happening, we had a decline because they were cheating the system, they were getting sued, so they needed the funds for that purpose. So unfortunately, we had to decline that as well. So very important that you take care of your character, especially your personal credit. So that way, in the event that you don't have business credit, then we can take a look at that as well. Number six is communication. This wasn't added too long ago, but I do feel that it's a very important one. So having that communication with your accountant and then also having that communication with your business banker will help you get you to the next level. But then we're two crucial advisors that can actually give you advice as to when to do certain things. So there has been times where our client says, Q4, I want to buy a piece of commercial real estate or I want to buy equipment. But maybe we see that the feds are going to raise the rates. So at that point, we call our clients, especially those that have already communicated their goals throughout the year, and we can tell you when the best time for certain things could be. So that would be communication. Now, closing out, we talked about the 60s of credit. And again, this is a roadmap of what lenders take a look at when taking a look at a business application. Now, as I mentioned before, there may be a time in where the banks or a traditional lender may not approve you, which is why today we have partnered up with SoCal Loans to bring awareness. In the event that your bank or your lender does not approve you, please don't give up on that. I actually have had several opportunities when I didn't know about alternative ways of financing that I lost out because I didn't explore other options or take a look at my resources. So definitely work with your accountant, work with your business banker. If you don't have any, please let us know. We'll be happy to connect you to one. And then now I'm going to go ahead and pass it over to Wilbur and talk about alternative financing.
Hi, good morning, everyone. Thank you, Valerie. My name is Wilbur Cabrera. I am the Vice President for SoCal Loans. We are a boutique loan brokerage firm here in the city of Los Angeles, where we work with business owners, making sure that we get them the financing that they need. And we do this nationwide. We work with many different chambers and different partners like Valerie to making sure that even though if for whatever reason the specific financial institution is not able to give them the financing, they're able to send them to us. We work with the client and then we find them the financing that they need to ensure that that growth continues to go over time. And if the business is growing, we're also growing with them at the same time, which is why I've been in the industry for over 16 years. So I wanted to start off by talking around commercial real estate, right? That's one of the major pieces that small business owners should own instead of maybe leasing or renting a specific property. This is a perfect way for a small business owner also to prepare themselves for retirement. We get a lot of business owners where in the future, 15 years, 10 years down the road, they're able to sell their business. They still keep the property and they're able to lease the property to whoever purchased the business from them. So that's something really cool that we're able to help those clients and facilitate that with them. And when you think about owner occupied real estate, that means that your business is going to be occupying that specific piece of real estate. Some of the terms that you guys can see is you can see anywhere from a 5-year to a 30-year term. In some cases, there are some lenders now that are starting to offer financing up to 40 years when it comes to commercial real estate. The down payments that you can be looking at are anywhere between 15 to 35%. There are in some cases where some lenders will offer a little bit less, but this is more on the conventional side. And I'll speak a little bit more on how you can actually put up to 0%. When it comes to investment property, what investment property means also is if your business is occupying less than 51% of the property and you're leasing out the rest, that means that you have an investment property because the property is now more of an investment producing property than your business occupying more than 51% of the property. And like how Valerie shared the 6 C's of credit, some of the things that we would be looking at is if you look at the right side on the needs list, you can see we would be asking for the first 3 years of the most business, the 3 years of most recent business tax returns, personal tax returns, a profit and loss, a financial statement, credit authorization, which once we collect all of this data leads to what Valerie was saying, where we identify the 6 C's of credit, see where that client is specifically in this specific stage. Are they growing? Are they staying the same? Where are they at? And how's their financial situation overall looking if they were on to take on this new debt that they're taking on, right? Because that's a commitment that you're making for the next, let's say 25 years or 30 years. And in some cases, you're able to pay those loans a lot sooner if you can. One of the other things that creates growth for small business owners, like Valerie said, if she presents a blank check to a business owner, right? How would you use these funds today? And that's one of the things that when it comes to small business owners, we work with a lot of manufacturers, we work with a lot of construction companies when it comes to like plumbers, electricians. A lot of these clients have what's called account receivables, right? That means that you're waiting to get paid either 30 days, 45 days, 60 days. Even though with what happened, a perfect example is with what's going on right now in the Palisades and what happened with the Altadena with the fires. Now we're getting a lot of these clients that we had these conversations around cash flow a year ago, 6 months ago. And now they're coming to us because of everything that has happened. Now they have a big project, but they don't have enough capital to be able to take on that new project. And they have to let that project go and pass it on to somebody else. So how do you prepare yourself when it comes to something like that? A perfect example is you can either have a business loan or a business line of credit. When it comes to a business line of credit, that means it's anything that you're going to be using in less than 12 months, right? It's revolving. That means you got paid in 45 days. Now you paid off the line of credit, right? When it comes to a business loan, that could be many different things. It could be that you need a business loan to purchase equipment because you're expanding, or that means because you have too much debt and now you have to consolidate the debt, right? In some cases, sometimes we have the monthly payments that you have are too much and you're not having enough money come in. So how do you restructure that debt? That's where we come in and we're able to help you and alleviate some of that debt. And maybe we can give you, on the average, when we're doing a loan, for example, of $300,000 to $500,000, we're saving the client at least anywhere between $3,000 to $5,000 a month in expenses that they can be having when they were having the payments breaking down into, let's say, 10 different loans. We put that all together, we consolidate all of that debt, and now you have one loan. One of the other cool things is right now, a lot of clients are retiring, right? So what we have is we have a lot of business owners currently that instead of opening up a second location or a third location, what they will do is instead of doing that, they'll just acquire a new business. And then, well, an existing business, but the person's retiring, so they'll acquire that type of business. And that's a way for you to not do all the hard work that you did when you started your own business. Now you're just taking over a business and starting from there. But the business, it's already been in business already. Some of these terms can be anywhere between 1 to 10 years. If it's equipment, it could potentially be longer, depending on the life expectancy of the piece of equipment that you're purchasing. And if you see very similar on the needs list, it becomes very, very similar to what we would ask when it comes to a commercial real estate, right? One of the only things that you'll see is, for example, Section 7, you'll see that it's account receivables, right? When you're lending specifically on a line of credit, you're lending on the receivables itself or the inventory. That's when it comes to the piece of collateral, right? That was one of the 6 C's of credit that Valerie spoke about. That's why this is very crucial for you guys to understand a little bit more in details on how the lenders look at this from a credit perspective. One of the other things is the SBA, right? So the SBA, I think it's the most, it's the best solution out there for small business owners when it comes to anything that it has to happen from a startup to an existing business, because they're able to help the clients and they're also able to help the lenders in guaranteeing some of the loans. So there are 2 different types of SBAs. There's an SBA, what's called an SBA 7A, which is one loan, and it's for 25 years, but it could also be for 10 years when it comes to anything that's non-real estate related. So an equipment, a working capital loan, debt consolidation, that's a perfect tool to use when it comes to debt consolidation. We do that all the time. We help a lot of clients are able to alleviate that debt that they have every single month, and we're able to give them that money back so they're able to put that into the business to be able to make more money. When it comes to the SBA, the two programs, the 7A, like I said, is 25 years. The SBA 504, that's usually, it's split into three pieces. One piece is from a lender, like a Bank of America, for example. The second loan is from the SBA, and the down payment comes directly from the client. It can be anywhere between 10 to 15%. The SBA 504 program also does loans for heavy pieces of equipment. Normally, the equipment has to be above $500,000. In real estate, what we're looking at with the SBA 7A program is now we're starting to see a lot of lenders offer up to 100% financing when it comes to real estate. So that's something that a lot of lenders are currently not there yet, but it's something that some of the lenders are starting to offer that when it comes to 100% financing. Just think when it comes to 100% financing, the risk is higher to the lender, which means that normally your rate might be a little bit slightly higher than what it would be with a Bank of America or a Chase or a Wells Fargo, for example, right? The rate might be a lot lower with a big institution like Bank of America, because normally you have to put 10 to 15% down. But when it comes with 100% financing, the risk is greater to that specific lender. So the rate might be slightly higher. And same thing, right? We need last 3 years of taxes, personal, business. You can start seeing the pattern when it comes to conventional financing and when it comes to an SBA loan. So now we'll talk into what's called alternative financing. This is financing when maybe you have a startup, or maybe you have somebody that doesn't have the best credit, or maybe you have somebody that needs to purchase the equipment and does not have the time to go through the traditional route, right? We work very, very closely with a lot of institutions where we will make sure to get that piece of equipment. If the client needs it in a week, we'll get the piece of equipment for the client. Now the client has enough time to go through the regular process that they would go through their institution, and then they refinance the loan that I provided to them. These type of loans are very, very simple. As you can see, the needs list, it's a one-page application, a one-page authorization form, 3 most recent business bank statements, the invoice or the information of the equipment. And the loans can be anywhere between $10 to $1 million. In some cases, it could be higher, depending on the business itself. The terms can be anywhere between 2 to 6 years. Down payments can be as low as 0%, but usually what we see is typically 10 to 40% down. But this is a very, very great tool for those clients that maybe their credit is not there, or maybe they don't have enough time in business, or they just have a specific type of equipment that they need to purchase because maybe they're getting a phenomenal deal. That's what usually happens, right? And now I have a perfect example, and we're working this with a specific bank. We're working with them where we were able to get the financing for the client. Now the client is being able to refinance that piece of equipment, but the client, just on that, because we did that for the client, now the client was able to save over $45,000 because we were able to help them that. So those are some of the different things on how alternative financing can be very, very helpful for small business owners. Now we go into bank statement loans when it comes to working capital, or pretty much any type of need. So alternative financing, when we use bank statement loans, and that's non-equipment related, it's really what's called revenue-based financing. And all of that means is, instead of me underwriting your tax returns, I would be underwriting your bank statements. So we look at what's called the daily ledger, for example. The daily ledger tells us how you ended that day. Did you end in a negative balance, or did you end in a positive balance? We look at how many deposits are coming into the account. Do you have any overdraft fees? And from that, we can calculate how much you can afford in a monthly basis. Most of these loans, you're able to get them anywhere between 24 to 48 hours. They move very, very fast, and it can go up to 10 million. Usually anything above $1 million, $1.5 million, maybe you're looking at a time frame anywhere between 2 to 3 business days usually, if the loan is that high. In some cases, the loans can go up to 24 months. And technically, these funds can be used for really any purpose of the business. For example, is if you're trying to buy real estate. We just started this. I know it says except purchase of real estate, but we just had a meeting today with some of our lenders where we're going to start doing bank statement loans, the revenue-based financing for real estate as well. Usually this product will be used as a bridge, meaning that a lender like Bank of America or Chase or Wells Fargo is going to be able to refinance that specific loan. And that's usually because the client doesn't have the time to go through the regular process. Maybe the seller is just in a hurry and they want to sell the specific piece of property, or whatever the reason might be. It's usually because the clients don't have the specific time frame to be able to go through the regular financing. But this is how we're able to help our clients to making sure that they're still going through the traditional financing, but we're also securing the piece of asset that they want to purchase. But very, very similar, right? You can see the business loan application, the authorization form, for most recent business bank statements. And like I said, we underwrite the bank statements, and that's how we calculate how much you can afford. One of the other things is most of these loans, they're unsecured, or sometimes they just put what's called a UCC filing. But when we do this, most of the lenders, because of how fast the transaction happens, let's say, for example, if the payment is $10,000, the way that the lender ensures to be that they're getting paid on time, what they'll do is that $10,000 payment, they will break it down into 4 every month. So instead of you having one hit of $10,000 every single month, what they'll do is, for example, on a Friday, they'll take out $2,500. So then that equals up to the $10,000 that you would be paying on a monthly basis. But the reason why they do that is to ensure that the business owner is also making sure that they're paying everything that they need to pay. So for example, when you're waiting to get paid, and you tell me, Wilbur, I get paid every 30 days, but what happens if that payment doesn't come in, right? That's why the lender ensures that instead of doing it monthly, they're doing it weekly, because the risk is a lot higher. As you saw, the needs list got less and less and less. That means the risk for the lender became higher and higher every single time, because we're going away from the traditional financing and now we're going to a completely different type of financing where we're just underwriting the bank statement by itself. And that's pretty much it. The FICO scores that we've seen around credit with this type of specific solution is as low as 550 FICO score. So we've seen it at 550, and we also seen it at the best credit score. But it fits most for the most part. One of the last ones that I will discuss is what's called asset-based funding. So when it comes to this is, for example, I have a client that came to me and said, Wilbur, I have a car collection and my car collection is worth $5 million. Everything is paid off. So what we're doing with him is we're going to be giving him a loan and putting a lien on the assets that he has, which is his car collection. The cool thing on this is the car collection that he owns, it's owned under his personal name, but what he needs is a business loan. So what we're going to end up doing is we're going to end up doing a 5-year business loan, but using his personal assets that he has as collateral to be able to do that. The client couldn't get any traditional financing. Even though we had to underwrite tax returns, it's done very, very, very differently on the way that we underwrite this. It's really dependent more on the specific asset that they have. And does the asset have enough equity in there for us to be able to give them that type of loan? And these loans can specifically usually range anywhere between 2 to 10 years. When it comes to the asset, it really depends on the life expectancy of the asset that we're securing. If it's real estate, it's different, right? The client can go up to the longer terms. But as you can see on here, it could be a heavy piece of equipment. It could be residential real estate. It could be a vessel. It could be an aircraft, or like I said, the perfect example was a luxury vehicle. But it's, as long as it has enough equity in there, we'll most likely be able to finance that for the clients. And they can use this specific type of solution for anything that the business might need. It can be debt consolidation. It might mean that they might need to buy another piece of equipment. It doesn't really matter what it is, but as long as the use is going to be for the business, we'll be able to help the client out. Yeah, and then these are just some of the examples, like as you guys can see, like an SBA loan, right? For a home health care, we were able to help the client with a 5% down. There's a very, very cool program that's called the State Guarantee Program. It's similar to the SBA, but this program, it's only for California. Every state has some type of form of this specific program, but the cool thing about this program is the fact that it could also help businesses that the SBA can't help. For example, like a nonprofit. A nonprofit can get funding through this specific program as well, which is called the State Guarantee Program. But yeah, that's pretty much it. If anybody has any questions, I'll turn it over to Carlos and Olivia.
Thank you both, Valerie and Wilbur. This is really great information now. I didn't see any questions in the chat, so I didn't know if anyone who is attending this webinar has any, but this is the time to ask those key questions with two industry leaders. You know, you have Bank of America present as well as SoCal Loans, but I did, I was taking some notes, but can you share a little bit more about how you underwrite the bank statements and kind of elaborate a little bit on that?
Of course. So one of the major things that we look at is how many deposits are coming into the account. What are the amounts of the deposits? Who are the clients that this specific business has? Those are other things that we look at. And one of the major things that, like I said, the daily ledger, every single day, we look at how does this business end every day? Do they end on a positive note or do they end on a negative note? So a perfect example is I just underwrote a client this morning. They have about $150,000 coming in, but almost every single month, they almost have the same thing going out. But I was able to uncover that the client also gets additional deposits, like cash, for example. 20% of his payments are in cash that he doesn't deposit. So what we're doing for him is I said, okay, I'm going to give you a month for all the cash that you get. I just need to see the invoices, but I need that cash to be deposited into the account. So in a month, I'm going to come back to him to be able to underwrite. Instead of me having 4 months, I'm only going to have 1 month, but I'll be able to see how he's managing that. And if the daily balance usually ends about 5 to 10,000, which he's going to, he most likely will qualify close to $100,000 loan. And he only needs about 50. So, but of course, right, like any business owner, if we give them more, that helps them out because that's gonna be able to help them grow even more.
So, thanks for clarifying that. And then you also mentioned bank statements. There was one loan that you use as a bridge loan to refinance existing loan. Would that loan be for loan for capita, to kind of keep your day-to-day operations going? Or is that specifically to purchase some kind of property, commercial property, or something business related?
It could be for both. So it could be for any type of expansion. I'll give you a perfect example. We have one with a specific lender where the client needed $2 million. The lender, the financial institution, was only able to approve the client up to $1.5 million. So they were still short that $500,000. So we were able to underwrite the statements, knowing that they just took a new loan with the specific financial institution. So I took that into consideration as well when I underwrote the deal. And we were able to actually facilitate the extra $500,000 to the client. He actually got an 18-month term, and we were able to get him a weekly a weekly payment, but it's literally unsecured. We were able to do that in about 2 days, and he was able to purchase the property that he needed. Without that specific $500,000, he would
Mhm.
not been able to do that.
Okay. Wow. Thank you. Thank you. So we do have two questions. One is from Alex. Do you assist with payroll funding, something to cover new hires, uh, for new contracts that will help subsidize until they are paid? So I guess, funding to bankroll payroll.
Yeah, so normally we'll take that as working capital. We can do it in multiple ways. It could be either if the business owner has enough time, we can either do that through an SBA program. If they don't have enough time, then we have to use the bank statement program to be able to facilitate that. The easiest way is what we can facilitate is anything that a business needs money, we will be able to do that because it's going to benefit the business in one way or another, whichever way it is. If it's because they need to hire more employees, we'll do that. Is it because they need to purchase technology to be able to help the business? We'll be able to do that too. The key thing here is, how is this loan that you're asking for, how is it going to benefit the business? And if you're able to explain that to me, and I'm able to explain that to the lender, then we'll most likely be able to find you the financing that you need.
Okay. The other question is, can we get an approximate pricing on the alternative financing loans?
Yeah. So on the alternative financing, for example, on an equipment, it really depends on many different things. Like Valerie talked about, the 60s of credit, right? So the further away you go from the 60s of credit, the more expensive it's going to be. But I'm doing a piece of equipment right now at 8.5. We weren't that far away from the actual financial institution that they were going to get. The financial institution is going to give them 7. They're going to be able to refinance. But same thing, the client needed this to be done immediately. But it can go from an 8.5. But if you have, for example, a 500 FICO score, you're not going to be looking at those rates. First of all, no financial institution is going to give you a loan with a 500 FICO score. So we'll have to go to a specific lender that you're going to be able to give a little bit more down, and your rate's going to be a lot higher.
Okay. And then, Valerie, one quick question. I know throughout time you've shared some information that you didn't discuss today, but I think it's really relevant for the audience we have. At the $25,000 grant, is that still available for commercial
Yes.
businesses?
Yes, so it is available. It's a $25,000 down payment assistance grant. And what it is if you're looking to buy a commercial property and it's going to be owner occupied, meaning you're moving in your business into the property, Bank of America can give you up to $25,000 to assist with the down payment in the LA County area. There's
Okay.
also 5 other areas throughout the country, and we're also looking to expand it to other areas as well. So right now we're
So,
piloting in 5 different areas.
oh, that's great. So it'll be more like the Southern California region?
So we are looking to expand it in the Southern California region. I can't necessarily say what area, but yes,
Oh,
it is
I
coming in
understand.
the next few months. It is in the plans, so it has been successful in the Los Angeles County area, and then the other areas that we have it, which is Chicago, Detroit. I don't have them all right now, and Atlanta. See if I can remember Dallas and Los Angeles. So we have them in those different areas, and we're looking to expand in different areas also, mostly in the underrepresented areas too.
Yeah, thank you. I didn't mean to catch you off guard. I should have asked you in advance, but
No, no, no.
as we were talking,
We
you know,
still
that
have
kind of came
it.
to mind. I'm thinking, I wonder if that program is still available because, you know, everyone that we have here, it's really important to know that there's grants available either for your business, for purchasing a home, and in this case, buying commercial property. Another question, if a client gets a $25,000 grant from B of A, do they have to qualify for a loan with B of A? You said yes.
Yes, they do. They
So
would
all
have to go
the
through it.
grant is given to you predicated on getting a loan approval.
Correct. Yes. And you could also use other grants along with our grant as well. So let's just say that you go to grants.gov, you find a grant there, you can add that on top of the $25,000.
Would you take a grant from another existing financial institution to help out or not?
If they're okay with the terms that we have to go through the loan with us, then yes. If they don't require for the loan to go through them, then absolutely yes. They can use other grants aside of, in addition to what we have here to offer.
And I know you've talked about the 6 Cs and you did that again this morning, but can you stress the importance of being aligned with those specific items only because it'll be the easiest way to get any kind of funding, not only through you, but I think it's applicable across the board when you have a relationship with, say, your own financial institution that is not, Bank of America, but it's kind of a platform that many others should use because it is key and relevant to getting any funding at all. Is that not right?
No, yes, absolutely. So the goal is for you to be able to get approved with those major lenders, such as
Mhm,
traditional lenders. And I don't just mean Bank of America, but Bank of America, JP Morgan, Chase, US Bank, Wells Fargo. So all those are considered the leading banks and the traditional lenders. So if you're able to put those first 5 Cs embedded into your full financial pictures, it pretty much puts you in good shape for
mhm,
you to be approved through those lenders. Now, in the event, like I mentioned earlier, if you're just starting off, maybe you have a shortfall in cash flow. Maybe you bought a lot of equipment, so your funds maybe are exhausted. Then that's when alternative financing with our nonprofit partners would come in, or an alternative type of financing like SoCal Loans has to offer. So yes, the goal is to be able to get you to come back to refinance or to be able to get financing eventually through the major lenders.
okay. Well, and then lastly, it seems that we are challenged every day economically on the bigger scale, right? So, we're talking about tariffs, but for those companies that need assistance with importing and the hike of the tariffs that are going to affect everything that comes into the US, is Bank of America or maybe even SoCal Loans can assist with that type of financial need?
Yes, absolutely. So anytime that there's an economic change or environmental factors that might affect, so it kind of goes back to conditions. Those
Mhm,
are definitely different reasons as to why you might be able to seek capital, right? And then also pivot your business based on the environment that we currently are in, right? So, for
mhm,
example, earlier I said that inflation was affecting a lot of our business owners. So 84% of our clients through our survey reported that they're being affected, but that's when access to capital might come in, or maybe they have to pivot or change the pricing, maybe explore different vendors or suppliers. But yes,
mhm.
definitely a working capital loan can help with that as well. I
Okay.
don't know, Wilbur, if you want to add anything on that.
Yeah, no, definitely. There's like what you said, right? The working capital loans, there's the SBA. A lot of people are not aware that if you're an importer or exporter, there's actual specific programs through the SBA designed just for your specific industry because we understand the challenges that you guys usually face, right? When it comes to importing it and exporting. So that's something to always keep in mind wherever you bank. You don't have to come through us or through Valerie, you can go to your financial institution and ask your institution, do you guys have any programs for importers or exporters? And they should be able to tell you that. It's usually through the SBA program that they have that. And other lenders definitely understand the industry that you're in. They're aware of what's going on. So if something is going on with that specific industry, that specific lender will have to readjust to that. We have specific niche lenders that's all they do. So when something like that happens, that's 100% impact on their industry. So they have to adjust to whatever is going on with the economy. And one of the things that our approach that we take is a very consultative approach where we hold the client's hand from beginning to end. And a lot of the times when you should be taking a loan is when you actually don't need the loan, specifically like a line of credit. You have it open, ready. So when something like this happens, it's there. Usually we kind of sometimes as business owners we work backwards, right? We ask for the money when we need it, but at that point the bank has you have a relationship with a specific financial institution and they have your history. So for example, if your account was at $300,000 6 months ago, and then now the account is only showing $10,000. There's something going on with the business, right? And most of the business owners have a relationship manager or have somebody that's usually able to guide them and gives them a call, see how the business is going, and will recommend specific solutions to the business owners. And they're recommending these specific things to be able to help your business and also to prepare you for any downturn, like what we're seeing right now with tariffs and everybody getting scared with those type of things. But also if you have rapid growth, you never know. You might be able to get a contract in the next 2 months, and you need that money to be able to grow very, very fast. So a perfect example was with everything that's going on with the fires. Like I have a client, he lost on a humongous contract because he couldn't get the financing he needed immediately. So those are those type of things that as business owners, we all need to think about that, right? Even myself, and my partner, we always think about those things, right? How do we prepare ourselves as a business owner if there's something that happens with the economy, right? So those are things to always definitely consider.
I wanted to add that it also has to do with managing your cash flow. So if you're able to manage your cash flow appropriately, you can get on top of it as to before you get in trouble, right? So, going through, like just Wilbur mentioned, going through a rapid growth, and maybe you don't realize you're growing because you're not watching your cash flow. And I always tell my clients, have that number in mind in your bank account of, okay, at this time by, I don't know, by the 15th of every month, I already have at least $50,000. If you don't have $50,000 and that's your comfortable number, then you want to explore and see what might be going on. Maybe you haven't billed out, or maybe your clients are slow paying. So those are things that you want to watch out for, and just make sure that you're on top of it so that you don't get in trouble and then have to turn business away because maybe you're not prepared for any type of contract that might come your way.
Yeah, that's a good idea. I have one question here. If I want to apply for a business loan with Bank of America, do I have to bank with them? What are my chances based on a banking relationship?
So you don't have to bank with us. However, we do have relationship pricing. So if you have a certain balances with us or certain products with us, then we definitely do give you relationship pricing where your pricing might be a little bit lower than what we would offer to the public.
Mhm.
So it definitely does benefit you, but we don't require for you to move your whole relationship here with at the bank.
Okay. And I think sometimes it's good to have those type of relationships with one or two banks just to not only spread the love, but be able to kind of manage your cash flow, your you can have revenue that you're saving, right, for those rainy days. So it's good to always have different accounts for different purposes. On that note, I'd like to thank Valerie and Wilbur for joining us this morning and kind of clarifying what alternative and traditional form financings there are out there. Thank you everyone for attending our session today. And please stay dry, drive safely.